Welcome to video 2A on compliance. This is the first chapter where we start to have to separate individual material from business-related material. Be sure and focus on the business-related components as you work through the chapter. Compliance is a term used to describe the actual tax return filing process. That is to say, how does a taxpayer comply? By filing a tax return. Let's start with filing requirements. Not all individuals are required to file a tax return. There are income thresholds that change based on filing status and age that dictate filing requirements for individuals. These thresholds are based on the standard deduction amounts. Prior to 2018, the exemption plus the standard deduction amounts. For example, in 2018, a single taxpayer with gross income below $12,000 will not be required to file, because whatever income they have will be eliminated by the standard deduction, which means that taxpayer will end up with no taxable income and no tax liability. Now, that is not to say that the taxpayer may not want to file a tax return. For example, if income taxes were withheld from their paycheck, in order to receive a refund, a tax return is going to need to be filed. In addition, from a protective standpoint, the statute of limitations, which we'll discuss shortly, will not start without a filing. Corporations do not have any such thresholds and generally are required to file a tax return for each year they exist. If there is any income to pass through, a pass-through entity such as a partnership or S corporation must file a tax return. Due dates vary. I'm not going to read these, but here they are. Taxpayers can extend a tax return for 6 months, but this does not extend the date for the payment of taxes. A fairly serious penalty starts to run for unpaid tax liabilities after the original due date of a tax return. As with many other parts of the law, such as criminal law, the tax law includes a statute of limitations by which errors on a tax return may no longer be corrected by either the taxpayer or the government once a certain period of time has elapsed. For tax, the general rule is that the statute of limitations runs for 3 years after the original due date of the tax return, or the date the tax return was actually filed, whichever is later. So, for example, SpongeBob's 2017 tax return is due on April 17, 2018. So SpongeBob files it on the exact due date. He discovers a minor taxpayer favorable error that was made on the tax return by SpongeBob. The IRS would have until 4/17/2021, 3 years later, to assess SpongeBob for additional tax. If SpongeBob had filed earlier than the original due date, then there is no change in the statute of limitations. It still runs until April 17, 2021. If, on the other hand, SpongeBob had filed on July 3rd, so he extended and then filed on July 3rd, now the statute expires 3 years from the filing date, because that's the later of the due dates. Of course, there are always exceptions. In tax, you got to just get used to it. If income of greater than 25% is omitted from the tax return, now the government has more time, up to 6 years, to try to get that money back. There is no statute of limitations if the tax filing was fraudulent, but the burden of showing fraud is on the government. Lastly, if you don't file a tax return, the statute is unlimited, at least until you do file, and then the general and other rules would apply. Okay, that brings us to the end of video 2A on compliance. Down the road a bit, when we cover corporations and pass-throughs in more detail, we're going to cover compliance for those entities in more detail also. But for now, thanks for watching.